Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. On this week's episode, I have Jackson Brissette and Brian Novak of Jofa Capital. Those names may sound familiar to you, and that's because they should. 3 years ago, I had them on this show to talk about the acquisition of their airplane hangar at the Hawthorne airport. Well, now fast forward 3 years later, they have sold the asset with an unbelievable return for their partners and their investors. They talk about how they created value, the tenants, the equity relationship with their partners, and how they were able to benefit from the advanced manufacturing craze that's going on in the South Bay, and particularly adjacent to the Hawthorne airport. So I hope you enjoy my conversation with Brian Novak and Jackson Brissette. Welcome to another edition of the Kirsh Connection. I'm here with my good friends, Brian Novak, Jackson Brissette of Jofa Capital? Jofa? What do we got?
Jofa.
Yeah. Just Jofa.
Mm-hmm. Jofa Capital.
Okay. All right. Jofa Capital. Gentlemen, welcome.
Thanks for having us.
Thank you.
I know you made it well over the hill from Woodland Hills, and you came from, Middletown, Wisconsin. Middleton, excuse me. So we have to break out some libation, I guess. Is that what people say?
Yeah.
To toast. Congratulations on a major life cycle, full cycle with the sale of your Hawthorne deal, which we will talk about. So
thank you.
I've got something special here. Hibiki Japanese Harmony whiskey, courtesy of my environmental lawyer, Brett Ober. So Brett, thank you very much.
Thank you, Brett.
We are opening this up. He may have even worked on your deal. I'm not sure if you had environmental issues, but what do we think?
Of course not. Super
this is
clean.
Beautiful. Thank you, Brett. All right, this is I think the second time that we've had alcohol on the Kirsh Connection, and apparently you knew the first time.
I did. I watched that one.
Was that with Justin?
This is Justin, yeah.
Yeah, with Harbor.
Was it Justin's idea?
Justin, Paul, Miskowitz, I think they like to drink.
Yeah.
So here we go. I'll let you guys pour first, and
Oh,
we're doing this live.
doing it live.
All right. So as Brian is pouring, you could pour for me as well, Brian. Thank you. And I'm sure everyone who's listening is probably bored to death that we are pouring our own whiskey and not talking about real estate. So a couple years ago, you guys came onto the show and talked about the acquisition of an airplane hangar in Hawthorne. And I thought it was fitting, really Jackson thought it was fitting, that 3 years later, we talk about the full transaction. Should I just hold up this whiskey the whole time? Ashley, would you like some? No? Okay. But before we get into the transaction, I just want a refresher for my audience, all 10 people, of your guys' background. So just, a minute or so from each of you.
Sure. So
And by the way, how is this?
should we cheers?
Great, yeah, cheers.
Let's cheers.
cheers.
Let's
Cheers.
cheers. All right. L'chaim.
Mazel.
That's pretty good, Brett. Thank you.
Not bad. So Jackson and I, we met at the University of Wisconsin. So we're real estate guys. Went to the business school there.
Is that school that just North and Northwestern, that Northwestern typically
Yes.
works in football?
Yes, exactly. I forgot you were a Northwestern guy.
Yeah, of course.
Let's see. First job out of school, worked at a real estate private equity firm in Chicago. Did the financial analyst gig. Mostly worked on new acquisitions, but also asset management. And from there, took a job with CIM in LA. Worked there a number of years, and mostly did the investments and development side of the game. And after that, had the opportunity to help open the LA office for Dune, which is a New York-based real estate private equity fund. And then after that, wanted to become a sponsor and mostly focus on work in the backyard. So, was sick of getting on planes, kind of going to major markets across the U.S. Wanted to focus on, really LA and California in particular. And then Jackson and I linked up and we formed Jofa Capital. How many years ago now?
We formed it in February of 24, but we bought the hangar in September of 23.
Okay.
Yeah. And I started similar private equity at Heitman in Chicago. We're actually fairly similar paths.
Yeah.
Development route, John Buck in Chicago, helped establish the San Francisco office with John Buck, came over and was working for an operator doing sound stages in Los Angeles, and then just had the entrepreneurial itch. Brian did it before me, and I was kind of jealous. He was doing his own thing, and we were just like, we were talking about hangars in Venice after a surf session.
Yeah.
Said it was an interesting product type, and it came across our desk through the bankruptcy lens, and we just fell in love with it and took the plunge, and it's been great.
No pun intended. Took a plunge while surfing, but people say, hey, deals are done on the golf course, but I guess deals are now done out on the ocean
In Venice, yeah.
surfing.
Right. That was the last time I went surfing, by the way.
Maybe you should surf
I
more
know,
often.
seriously, we need a new deal. Should go surfing.
Yeah.
Yeah. We were mentioning, I was mentioning before we started recording that today I closed an apartment acquisition in Vegas. I'll give a shout out to Brent Josephson, Birch Tree, and it was his first deal as a sponsor. He had been on the equity side,
Amazing.
institutional equity side, and it was a totally different experience for him. Yes, raising capital, finding the deal. He thought those were the tough aspects, but it really was chasing the UPS guy and making sure chasing the lender's wire at 2 p.m. saying, where the hell is it? And other little things like that.
Estoppels and
that
all
they
this-
don't
yeah.
teach at Wisconsin or any real estate school. So let's get right into it because I wanted to do almost like a Wisconsin case study on this deal. It was such a unique deal when you bought it, and when you sold it, I had clients, one particular landlord of mine who will go unnamed, but everyone will know who he is, say, God damn it, I know I should have invested in that. So how did you come across this deal in Hawthorne?
So I think it was either through a separate attorney or there was a small blast that went out through LoopNet, but it came across our desk somehow. It might have been an email, and we saw it and said, oh, I saw a hangar, come across in Hawthorne. We like that industry. It's kind of a cool, they don't make many hangars, right? And so we went there and we toured it and just immediately fell in love. It was just obvious how we didn't know what a through the fence agreement was.
Or a fuel farm.
No idea. But we knew it was great real estate in Hawthorne. It had a through the fence agreement, which gives you runway access, which we didn't know at the time, but only like 200 of them exist in the entire country. So we just immediately knew after 15 years of real estate, you kind of know when something's special, and we felt it. And then we found out it was in bankruptcy, never done a bankruptcy deal, and just fell in love with bankruptcy. Talked to you, and Robin at the time helped us, and just learning about how we deal with the court system and the stalking horse bid. We just went all in, and we ended up, raising our initial bid to get it to become the stalking horse. We put up we signed the contract on July 4th of 23 and put up our own personal money, which we had never done, or you probably did, but I hadn't done. And just took a swing.
So you just literally glossed over like a half a dozen different aspects of the deal that any one of them, I would say most of my clients would have said, too confusing, too much brain damage, forget it. And
he did say that.
And many did say that, right? From location to asset class to bankruptcy to what the hell's a through the fence agreement, through,
What's a stalking horse?
All of that. Yeah. Who's going to use this space? And on your first deal, your own money, did you just you guys have just balls of steel, or what is the fact? How were you guys able to just not get so nervous about all these issues?
I think so. now hindsight, what you just described is our entire thesis. What you just said. We love deals where everyone says that too complicated, not big enough, environmental contaminant, like just too many things, right? We love those deals. At the time, though, it was more just we knew it was special real estate. And we did like kind of a back of the envelope, just price per pound analysis. And we thought we were buying it for sub 200 a foot for Hawthorne. And now looking back, we sold it for 800. But we just thought the basis was good. And it was just a gut feeling. And we said, you know what, we'll have a DD period and we'll raise equity. And frankly, the raising the equity process, equity tells you if it's a raisable deal, right? And we would know. So we just thought it was worth tying up.
Yeah, I think there's a common theme around the deals that we do, and that's optionality, right? So this is like a 40-foot clear building, clear span, and we were looking today at the acquisition memo that we put together, and some of the ideas that we had were just like pretty outlandish, but also feasible, execution.
Brewery, basketball court.
Yeah,
and that's the other thing.
Yeah, something with I know you were talking about possibly with the Clippers.
That's the other thing. So we knew immediately it was good real estate because we talked to like 6 people, tenant rep brokers, et cetera, who immediately said, I need to have it type of thing. And it was kind of like, all right, this is interesting. I think we've got some interesting real estate here,
All right. So you learn about it. It's a competitive process. I mean, how did you guys get selected?
Price. We did price and just speed at underwriting, and the process getting kicked from Chapter 11 to 7. The judge wanted to pick someone right away, and we just presented well, toured it multiple times, showed our underwriting, and just had a number that cleared the claims.
Now,
and they picked us.
When you were being interviewed, did you have your capital set up?
No.
So many of my clients, even today, well-established second, third generation real estate companies find it challenging to win deals if they don't have a plan with respect to their capital to present that to the seller and the broker in the buyer's interview. So no offense, but to you guys who were doing, your first deal and one of your first deals, how did you guys get selected without having a capital relationship?
I think we agree that that's probably challenging with an institutional seller where you need, a $50 million deal, institutional seller, you definitely can't just tie that up as Brian and Jackson. But this was, the bankruptcy situation, the brokerage group on it, it was pretty non-institutional, I'd say. Do you agree?
Yeah. I think there's also a common theme. We try to fish in an area of the lake that there's not many other boats, right? And it's not necessarily that the real estate is messed up and that's why people aren't fishing in that area, but there's a special situation, whether it's capital stack related or bankruptcy or whatever it might be, that kind of allows us to tie something up. Because if we're bidding on a highly competitive deal, why would they go with Jackson and Brian, right? I mean, we don't have discretionary capital. We raise it deal by deal. So that's kind of where we found the opportunities, and sometimes you get lucky.
And so you were speccing some money on your own. At what point, when you had to go non-refundable, did you have your capital?
Yes, we did.
You did. Okay. But you still had to spec some dollars. You had to write the initial deposit, even though it was
personally,
a refundable deposit. You still had to write that check. Tell me
some legal third-party DD.
Tell me what surprised you about the bankruptcy process and things that you could help my audience, I guess, learn in terms of buying an asset out of bankruptcy.
Well, at the time, we knew nothing about bankruptcy, so everything was new.
And you had my former partner, Robin Itkin.
Yeah. I mean, having a Robin involved to know the players, the trustee's attorney, is huge. I would say looking back now, though, it actually was a very efficient process from what we're normally looking at in bankruptcy now. Do you agree with that?
Yeah.
Like I feel like what we normally look at these days, they don't really have the plan figured out. This was very it was Chapter 11, judge kicked it to 7, wanted it liquidated. We came in, we did our DD, we went to auction, it was done. There were some issues with the litigation, remember, with the various parties in the settlement agreement. And then the debtor kind of had that interesting thing at the end where he, disagreed, but didn't really have any control. But for the most part, it was actually very smooth. But at the time, yeah, Andrew, we didn't understand like what, claims were and how you had to clear the claims for the estate, right? What we knew was there was a, purportedly predatory lender, and then some litigation and perhaps like a few title issues. And we felt like we were getting a good value for like taking that risk, if you will. The litigation was actually something that didn't run with the land, remember? So we were fine with that. But at the time, I don't know if anything surprised us other than just maybe the cast of characters involved. It's just a lot of, it's very different from like an arm's length institutional deal where you have like Blackstone selling you a deal.
Today, I helped you guys with capital introductions, and it's challenging. It's just challenging out there, right? Like everyone wants a story. Equity has, I perceive, an unrealistic expectation on returns as it relates to what operators can really deliver in reality. And so it just seems harder now more than ever to get JV capital. Talk about what it was like to get capital for this deal in Hawthorne, airplane hangar, bankruptcy, and all the other issues that we've talked about.
Yeah, I think high level, I would say, I think it's harder to find the deals than the capital, because we believe we find, we don't do many deals a year, right? We're lucky to do one a year, but we think that the deals we find are interesting enough that it's not the capital that's the problem, it's finding the deals. On this one, the challenges were definitely, size. It was like a little bit small for your classic PE shops. The hangar use, right? The learning about the fee simple nature, the fuel farm, the through the fence. But in the end, we probably had 5 to 6 term sheets because people thought it was like, they liked the basis. They knew that you already had Tesla as a tenant, and we were pretty positive we could lease this thing. And you look at the comps, I think we underwrote 225 net, right? So you looked at it, you were like, all right, your downside is like, I think we can get this thing easily to a 7.5%, 8% return on cost. So you're in the money. And then we thought the upside with the fuel farm, where you either kind of build your own FBO business or you lease it to an FBO or you do a revenue share, we were kind of getting into the 9s, the 10s. So it had opportunistic juice with like some good downside in a great market. That business park was 2% vacant at the time. Now it's like 0. Right. So had a lot of good stories, but it was the classic things you were mentioning that were kind of the immediate, with equity raises, you got 50 people and 30 of them are gone for those things I mentioned. So like 10 are gone for size, then the rest, it just trickles down. But we felt like the last 10 were really solid and we got 6 great term sheets.
So ultimately you partner with Farallon, and, Farallon is a fairly institutional real estate private equity company. In fact, I reach out to those guys and say, hey, are you interested in XYZ? And they've said no to all of them. So what is it about? Was it just the unique opportunity and the ability to get this type of return in an infill market that sparked their interest?
Yeah, I think it was pretty esoteric, which they like. The return profile worked. The size was a little small, but it still worked. And then ultimately, I mean, we might have talked about this on the first one, but the funny quirk of this deal, if you recall, was when we found out that the runner-up on the stalking horse was a gentleman named Biz Brackett at UIRC who had already done deals with Farallon. That's when we kind of all got married together, and I think they really kind of liked that it was Biz wanted to do the deal. We outbid him. Of course, he was like, who are these youngsters tying this thing up, So I think they really like that.
So you ended up having not only a JV partner for the LP, you also had a co-GP. And how was that relationship?
Amazing. He's not coming to the closing dinner tonight, unfortunately, but he's great. Yeah, we love them. It was a great, we feel like we're family with all those guys. We love Farallon, love Biz and UIRC. It was great. It's what you want. This deal was, I told Brian yesterday, I don't think anything went wrong on this. Everything went right on this deal, and the marriage, the JV, was perfect until the day we took best and final bids and the Iran war started. And that's when we thought,
on the sales side.
on the
Oh,
sales
when
side.
we were selling.
And that's when we thought, oh, now something goes wrong.
Mhm.
Ended up being fine. We did sell it with no issues, but
So you buy it. Well, before we get into the acquisition, a common conversation that I have with clients of mine who let's say they typically capitalize their deals through a syndication, and they want to go and get JV money, or they want to have a co-GP partner. And the issue is control, giving up control, having somebody with a seat at the table. Now you've got two different partners at seats at the table. Talk about that dynamic.
I didn't really have an issue with it, to be honest. I think it can become an issue if you have bad partners. Thankfully, we had great partners, right? But Biz and his group had history with aviation. He's a pilot himself, so totally understood the ask, from Farallon, to bring him in, as a co-GP partner. But I don't think it honestly never came up between you and me as like, oh, we're giving up control. Although I do remember signing everything over very specifically, being like, oh, wow, this is like our child that we had like cultivated and raised over the last 6 years.
Oh, you mean like the contribution agreement and everything, like the entities? Yeah. I mean, well, just from a JV control perspective, if you're putting in very little money, you shouldn't really expect control, right? So there's that, which I think we were fine with. But like the day-to-day sort of like asset management control, I think was still, on us so long as you're doing your job, right? Which, it felt very typical for a JV.
Any issues, any partnership disputes, anything, not disputes, but like, oh, I would have done this and they want to go this way.
Everything went so right on this deal. The business plan was interesting, right? So we had that weird, inflection point of, do we actually want to open up an FBO, right? So if you recall, it's fee simple real estate. You've got the terminal building, the hangar, and the R&D building, and then you've got the land that we call the ramp that leads to the runway. So like the fee simple real estate business plan is just real estate. You lease it, right? The ramp is interesting because you could lease the ramp and the fuel farm to an FBO or start your own, or you could do a lease with a charter company or a NetJets where they have the hangar and the fuel farm and you cut a margin deal on the fuel. So it was more the business plan where we were like, are we going to start our own FBO? Are we going to lease it to a NetJets? And ultimately that never became a dispute because, we met the guys at Eureka and Fortune 100 company and cut a, 7-year lease. And then it eventually extended it to 15 years.
And so that was the business. Or talk about like your business plan in terms of how you originally, I know you had several ideas to what you guys ended up doing for the 3 years of ownership.
So I don't know what Farallon took to IC, but I can almost imagine it was some form of like 2.25 net on the real estate, and then you would roll Tesla's R&D building to market. They were at like 170 or something. So you roll that to 2.25. But we probably underwrote an aviation use in the hangar and terminal with a fuel override. So you do like a 2.25 net deal, and then you charge them an extra $1 because, you're doing a $1 override on the fuel or something. I bet that's what we underwrote. And then we eventually did a deal where our tenant took all of the fee simple real estate for a much higher number than pro forma. And then we ended up leasing the ramp and the fuel farm to the other FBO on the field to capture that demand and basically control the whole field, right? So, the Farallon folks, they're real estate guys that we were interested in starting our own business, but I think that putting that to bed with a Fortune 100 company and leasing it to the other FBO was kind of like a no-brainer. Above pro forma, you don't have to start up and create your own company, right, in an FBO and hire employees. It just simplified things. So
everything was triple net. Yeah.
So when did you decide to sell, or whose decision collectively, or did somebody
Once we fully leased it.
and said, okay, it's time?
Yeah. Well, so we did the original deal for 7 years, right? And then what happened was our tenant came to us looking for some TI dollars to spend a lot of money, new ESFR sprinklers, the whole works for a, extension. So once we extended for 15 years, we just said, this thing's put to bed. Oh, and then the other thing that went right was that FBO I mentioned who leased the ramp, they got bought by a public company, Archer, the eVTOL company. So the whole airport got bought. And so we figured, oh my gosh, now we have a Fortune 100 tenant on the fee simple and this new public company in this cutting edge, new, sort of low altitude space that everyone loves. We have to sell this thing. I mean, Farallon's a hedge fund. They're incentivized to sell it. We all thought we had created a lot of value. So we probably decided in probably early 25. No, mid 25 probably.
Yeah, that's probably about right.
Yeah, went to market in late 25.
Farallon's a private equity fund, so everything's IRR based, right? So, it's not, I think if Jackson and I, had the opportunity to own it forever, this is just such special real estate that we would have loved to. But at the same time, once you've created the value, there's not a lot of juice left, right? So, they're not holding for cash flow, they're holding for total return. So,
and we did refinance it. So once we did the Tesla deal, we refied it and basically took out all of our cash, right? And then once we did the extension, we said, okay, this is now at a, if we did a 7-year deal and we held it for like 2 years. So 5 years of remaining term was sort of an odd sale. But once we did the 15-year, then it was like, wow, we have a triple net lease Fortune 100 bulletproof mission critical deal. This is pretty sellable. And we had CBRE, Mike Longo's team do it.
And so what was the sale process like? I know you mentioned the Iran war started, but what was the demand?
It was pretty classic, like efficient brokerage, go out with a blast. We had a marketing campaign, collect the CAs, set a bid date. It was very formal because we really wanted to push, the rounds and get people. Once you toured this thing and saw what the tenant was doing, everyone who toured it was astounded. I mean, it's truly special mission critical real estate. So we felt like get as many people through, set the bid dates, do multiple rounds, get people in love with it, get them, oh, you're in the mix at 27. Oh, I think it's going to 28. Eventually went up to 32 and a half. So they ran a phenomenal process and we love, Longo's team.
That's incredible. I had Jake Bobeck from CB on the podcast a couple weeks ago, and he just talked about how hot the entire South Bay is, from Hawthorne Airport, El Segundo, the SpaceX, and he says it's going into like Torrance and Hawthorne and possibly into Compton, and it's just this demand. He said there are close to 200 startups in that industry, and he gets requests for 1 million square feet every week.
Yep.
It's just insane.
Well, that's the other thing that went right for us is just the, no pun intended, tailwinds of advanced manufacturing from El Segundo, which would be the core, to, Irvine, right, down to Anduril. And so that from we had everything going right for us. Mission critical real estate, credit tenant, tailwinds from this, advanced manufacturing, rarity of, fee simple real estate with a through the fence agreement. I mean, it really couldn't have been a better offering unless it was newly built, right? It's a 1960s building, but it was Jack Northrop's original hangar. So it's got history. I mean, it had everything. And we see that too. And I think, we proved out the price per pound in the South Bay. It was $801 a foot. I think if you ask, Bobeck or any tenant rep broker out there, that's the struggle now, is because a lot of those startups you mentioned, there's no credit. So they might sign a $350 net deal, but are you going to sell your building for $900 a foot? I don't know. But we set the 801 mark. Now ours was credit.
And when you bought it, you said it was just under 200?
Yeah, it was over 200 with the fuel farm. We say under 200 because you allocate value to the fuel.
But whatever, it's incredible. And
we bought it for $13,350, put no money into it, and sold it for $32,500.
I would say that's a home run.
Yeah, it was a good first deal for Jofa. That's for sure.
It's a good deal for the resume and the website. It's far exceeded your underwriting.
Yeah, I think we underwrote it to, a classic like 2 and 20. It was, 40 and well over a 2.
Yeah. That's incredible. Well, that's why we were drinking and wanted to.
We need another one.
Another deal or
Oh, no, another deal.
another whiskey?
No, another deal.
You could have both. I can provide the whiskey at the Kirsh Connection. I cannot provide a deal right now where I'm sitting. But let's talk about what's next. So, we're almost 2/3 done with 2026. That's crazy.
Yeah.
Talked about the South Bay and what's going on there. And I know that you guys are looking far and wide. I know, Jackson, you and I have had conversations about crazy deals throughout the country. So how do you replicate what you just did?
I wish we could. I mean, that was a, needle in a haystack deal, I think, but we feel like our edge is finding special situations. So we've developed, this proprietary AI model to scrub bankruptcy dockets all over the country and scrub these petitions, find deals that fit our niche. But it's really just being able to find situations and assessing the real estate or the real assets, as we call it, after the fact, because we feel like the situation is what drives the story and the basis. And we can work on any real estate. If we find a marina that's in distress, we'll do that deal. A golf course, advanced manufacturing, whatever. So I think that's our edge, is just being intellectually curious and focusing on things that other people don't.
What was your inbox like, or your cell phone just getting blown up after the deal closed and you guys went public? I mean, has there been a lot of inbound opportunities?
I think a lot of congrats and, questions about the basis and the cap rate, stuff like that.
Mm-hmm.
The South Bay market on, it's still expensive, right? So on the buy side, I wouldn't say that the hangar sale has led to that many inbounds that are actionable. What do you think?
Yeah, I think that's right. I think aviation just piques people's interest, right? Everyone's flown on a plane, but, never owned a hangar before. So I think it's close enough for people to be like, oh, that's interesting. Like, how do we get in the aviation space? Or, what do you guys find interesting in the aviation space? And to us, it's super simple to understand. There's a limited number of airports that exist today, especially in urban centers. And oftentimes, local cities and municipalities are shutting them down due to noise or otherwise.
You look at Santa Monica.
Santa Monica that was in our acquisition memo. We had referenced that, closing in 2028, right? So you have a dwindling supply and ever increasing demand for this use. So it's just really easy for people to wrap their, arms around the general investment thesis. So we would love to do another aviation deal. We're underwriting a few right now. But yeah, I think it was a special deal, and quite frankly, every deal we did after that was not aviation related. So it would be great to kind of put everything that we learned in this deal to use again.
Speaking of Santa Monica, do you think it's really going to close in 2028 when JSX is expanding its routes in Santa Monica? I took it to Vegas, then I took it to Scottsdale. Now they fly to Napa. I'm like, oh my God, this is amazing. It's 10 minutes from my house. Now I know those that live near the airport, they can't wait for it to close and turn into a park.
We were just
I don't understand JSX of why they're spending all this time, and unless if it's just great cash flow, and then when it closes, maybe they'll go to Hawthorne. I have no idea.
Could be that.
Yeah.
I'm sure it provides a good amount of revenue for the city of Santa Monica, which is important for that city. But we haven't tracked that one as closely because, because of the closing, but also, it is a fairly small runway, and so is Hawthorne. But we typically focus on aviation deals that are longer runways that can fit the bigger jets, so like over 5,000 feet of linear runway length. And Santa Monica would be 3,500.
So how, in terms of people who are graduating from college or maybe an MRAD program, Master's of Real Estate, or they're leaving an institutional job and they want to do their first deal on their own, any lessons that you learned or advice that you could provide them? Because and it's not even an age thing. It's you could be in your 40s, you could be in your 50s, and have worked a W-2 job, a very comfortable job, getting paid handsomely. And then when you go on your own, it's just a different beast. So, I don't know. Any thoughts?
Definitely, I would imagine much tougher to leave when you're getting paid super handsomely in your 40s and 50s.
Yeah.
I think like what I always tell people is you have to first start by just looking in the mirror of, do you want to be an entrepreneur? Some people they might be good at it or could be good at it, but they just don't want to, right? And maybe they're not right for it. So I think studying that about yourself, and you'll know if you every day wake up at your W-2 job and you just want to be doing it on your own, then you should probably think about it. You got to run the math on how many deals you need to buy to replace your salary. Are you willing to take zero for years? Because building a sustainable real estate business like ours with no discretionary capital that's a 5 to 7 year run of trying to buy deals, and you sell one and you lose fees on that, and you got to buy another one. And to really, make it sustainable, I'd say it's 5 to 7 years. So I think it's studying if you're willing to do that, and what type of deals could you tie up? How big would they be? Do you want a JV or do you want to syndicate? And then looking at that like replacement of your salary, right? And is it feasible? And it is. You can definitely do it, but I think it's easier younger, personally, because like I said, that sort of the golden handcuffs aren't as strong in your younger years.
Yeah, I would just add, I think it's important not to have an ego. There's a lot of just unsexy things that you need to do. I have a picture of Jackson wearing a raincoat, like sweeping water off of the roof at the hangar.
How come you didn't do it?
Oh, he was doing it.
Oh, okay.
Just being a sponsor, you have to kind of roll up your sleeves and do the tough, gritty work. Like, we don't have an analyst pool. We don't have, in-house counsel for legal, right?
Accountants for entity fees.
Yeah. I spent hours just like paying entity fees,
paying your California and Delaware fees. It's just like non-sexy stuff that, if you got a cush W-2 job, you start to get a little bit of an ego because you can spend the company coin to go out to the nice place in Beverly Hills and schmooze with the big time attorneys and the private equity folks. And like, if that's what you love about it, then maybe the entrepreneurial gritty route isn't for you.
Yeah.
It's like studying yourself.
I schmooze on Sawtell. Well, I'm glad we did this. I'm glad that we have an opportunity to talk about an entire life cycle of a deal. So often we talk about the buy, but we don't know what ends up happening on the sell side. And so it's just a great testament to you guys. I can't believe it's been over 3 years, or almost close to 3 years.
Yeah, close to 3 years.
Yeah, and time flies, definitely. And obviously a lot has happened in between, but I'm sure that I will have you on again to talk about the next life cycle of some interesting deal that you guys have going on.
Well, I just want to say thanks to you, Andrew, specifically with this deal. I'm actually not sure we would have actually closed without you, because you introduced us to a number of capital partners. And, just working through the PSA and the bankruptcy stuff, like, you were invaluable to it. So thank you.
Thank you.
Nah, look, appreciate it. It's love being part of, well, it wasn't Team Jofa then. I don't know.
It wasn't. Yeah, it was
Team
Sherwood.
Yeah, and now it's
which
Team
is
Jofa.
also a hockey reference for
Right.
those who don't know.
Yeah.
Both Jofa and Sherwood.
I love it. Well, it's good to see you coming in from Wisconsin, and you from Woodland Hills, and much success in the years to come.
Thanks, man.
Thank you.
All right. And that is another edition of the Kirsh Connection.